What's going on, everybody? In this one, we're just going to talk about why dividend investing is like my favorite style of investing, especially for the long term, because there's a lot of different styles of investments. You can go with ETF investing, which is something that I strongly like as well. My Roth IRA is strictly ETFs only. Also a massive fan of dividend investing, as you can tell. Like, I'm making this video talking about why it's my favorite. Growth stocks, like there's all these different types of investments that people can make. They can focus strictly on cryptocurrency, different things like that. But for long term and more stock market investing, I'm going to talk about why dividend investing is my favorite. What you're looking at right now is my dividend stock portfolio. If you're new to the channel, subscribe, turn on post notifications to miss out on any future videos, all the good stuff. At the end of this video, you'll have learned a lot of information. Check out M1 Finance if you haven't already. Using the link in the description or pinned comment down below, you can get some free money just by depositing money into your account. They might be giving you $10, maybe $50. I'm not exactly sure how much the promotion goes on right now. It switches all the time. But let's go ahead and talk about why dividend investing is the best style of investing. So pretty much there's going to be 7 main reasons why I think dividend investing is really good, or really 6 main reasons, and then we'll talk about the cons. But let's go ahead and talk about reason number 1, and that's yield on cost. Your dividend yield on cost is absolutely mind-blowing. So an example of yield on cost going insane, like for example, let's look at Warren Buffett and Berkshire Hathaway, okay? They're right now receiving a 52% dividend yield on Coca-Cola stock, So he's doubling his investment every 2 years in passive income. Coca-Cola's current dividend yield is around 2.75%, and he's able to achieve this insane yield by buying low and not selling. So what he did is he bought the stock when it was really cheap and held for a long time. So his average cost compared to his dividend yield that he's receiving is 52%, which is insane. So here's some proof from Motley Fool. One of Buffett's most famous investments now pays Berkshire about a 50% annual dividend. That's insane. Okay, here's another part of that article that I was reading. Based on today's dividend, Berkshire received $672 million in Coca-Cola dividends for its 400 million shares. This is against Berkshire's overall cost basis of $1.3 billion. Good for a yield of 51.7%. That's insane when you really think about that. And if you just hold on to some certain stocks in your portfolio, maybe even ETFs per se, you probably won't get a 52% yield with an ETF, but you can definitely get a great yield on cost. With some stocks, you can definitely get 52% if you made the right investments and if things go right. It's definitely possible, and yield on cost is just absolutely insane. Next up, let's talk about how dividend stocks perform historically in the market. So they have historically proven to create greater long-term returns and gains because it's like, think about it like this. Growth stocks are very volatile. We've seen growth stocks completely plummet over the past few months with interest rates rising, inflation, Russia-Ukraine tensions, things like that. And dividend stocks continue to pay out these dividends. They're usually going to be more established companies with a good foundation, maybe have a solid moat, and they're just more sustainable. And these growth stocks can get big, hit big with no recovery returns, like we're seeing a lot of these stocks now. So here's some kind of images. We'll see dividend growers, initiators, dividend payers. Both performed far better than the S&P 500 from 1973 to 2020, which is big. You go right here, and we just see that non-payers perform the worst, and then the highest payers of dividend perform the second best, and the second highest group of stocks that paid the second highest yield performed far better than everybody else, okay? From 13,000 to 7,000 to 3,000 to 3,000 to 1,700 to 964. That's the growth of 1 million. It's a lot from 1928 to 2012. These dividends make insane returns over the long term. Now, the income is just completely passive as well, okay? Here's a little vision for you, to see that. Once you buy your stock or you buy your ETF, whatever it is, you don't have to do a single thing. Like literally, maybe the most amount of work you would have to do is take that money from your brokerage account and put it into your bank account. You just hit like 3 buttons on your phone, and that's it. Active income, you have to go to work, give your time, do the work, and then you get paid. And it's completely passive with dividends. And one thing I'm going to mention is I know some people have to work. Like for me, myself, I could not sit around all day and not do anything. And so I completely understand. But why not choose to work and have dividend income stacked on top? You know what I'm saying? And you can get paid while you sleep, spend extra time with families, friends, go on vacation, whatever you want to do on your own terms. Next up is going to be the dividend snowball effect, drip. Because dividend reinvesting is insane, okay? It provides you with cash flow, and if you take that cash flow it provides you with and put it back into your stocks, it's going to give you more cash flow in the future, which is insane. The more and more you invest in yourself, like you put money from your job into your portfolio, and the more you reinvest your dividends, it's like two birds, one stone, and you're just going to be getting insane dividend income, okay? Here's a chart computing with the S&P 500 without dividends, and here's a chart with the S&P 500 with return dividends. From 1960 to 2020, $10,000 without dividends grew to $627,000. With reinvesting dividends, that same $10,000, same amount of time, literally no different other than reinvesting those dividends, turned into $3.845 million. That's the power of dividends in compounding, Even when you go back to 1970, about 84% of the total return of the S&P 500 index can be attributed to reinvested dividends in the power of compounding. They're also perform a lot better in bear and flat markets. So when markets are trading sideways, if your stocks are coming from solid and stable companies, you should be receiving cash flow, which is going to provide you with some return per se. And just to add, inflation is concerning, and dividend stocks are a good hedge against inflation at most times. We've seen lost decades, but in the 2000s, dividends provided a 1.8% annualized return over the decade. And while all these growth investors and tech investors and things like that, even ETF investors lost their money completely, dividends provided a 1.8% return in the S&P 500. So keep that in mind. And then we got dividend payments and emotions. One of my favorite feelings is waking up and seeing, hey, I got dividends today, even if it's $5, $2, whatever it might be. It could be it could be 30 cents, but that's 30 more cents than I had before I woke up, And seeing that money coming in is very motivating per se. And if you take that money, you reinvest it, you put more money into your account, you do what you can to build your portfolio. One day, if you trust the process, your dividend income shouldn't be $5 a day. It could turn into 50, 500, 250, whatever it might be, whatever your goals align with. In growth stocks, they can often get hit big, and investors negatively stray them away from the markets, and the emotions that come into it just kind of stand out with dividends, Here's a little tweet I saw once. $4.12 in dividends isn't very cool, but today that $4,120 in dividends rolls in, that'll be pretty cool. Keep building and trust the process. Now, dividend investing is great, but nothing is perfect. So let's go ahead and talk about the cons that come with dividend investing, First up is the taxes. Once you get these dividends, you are going to pay taxes. Now, if they're qualified dividends, they are going to be lower than your regular income taxes. That's one thing that growth investors have. They don't pay taxes until they sell. You pay taxes on your dividend income. Next up is some people say they have slower growth, but long term, we looked at the case studies, we looked at a ton of different things. Long term, they do perform better. It's just about being patient. And they have less potential for massive stock gains. A dividend stock that you own that probably has a 4% yield is probably not going to come up with some insane news, and the stock's probably not going to go up 30% in a single day. You have to be patient for huge stock gains in these. Also, companies are not required to pay dividends. If they feel the need to, or they just kind of want to, and it gets approved, they can 100% cut that dividend, even if they've been paying it for 60 years plus. They have that ability to cut it. And dividend yields often aren't that high, and if they are really high, they're probably going to get cut. So you have to be careful with what you're investing in. Next up is emotions, because as we talked about in the last slide, emotions can be a good thing with dividend investing, but they also can be bad. You might just be on TikTok. I know I used to see things all the time, oh, this person did an options trade and made 25 grand in one day. Oh, this person made 75 grand by option trading, this, that, this. You kind of almost say, oh, well, I can do it. It's a lot harder than it looks, and as people portray it to be. But it's not the easiest just seeing others make all this money while you're almost feel like you're not doing anything. Next up is you got to be patient. If you're not a patient person and you want to be a dividend investor, you've got to learn to be patient and trust the process. Lastly is going to be bonds. A lot of people might argue, well, let's say your stock stays flat and you only get a 3% return. Well, what if you can go find a bond that provides 5% returns? Why wouldn't you just stick with a bond? And things like that. If your stock falls and you get 3% and you're losing money. A lot of people might say bonds are safer, bonds can be more reliable, things like that. And there's a lot of counter arguments on that. Personally, I don't invest in bonds. I prefer stocks, and ETFs, things like that. But those are the main cons when it comes to dividend investing. So that is going to wrap it up for this video. So thank you for coming by the video. Thank you for making it to the end. Leave a comment below. I always love to hear your input. Check out M1 Finance using the link in the description or the pinned comment down below. If you haven't already, deposit some money, get some money back. It's free money that they're handing out. You can take that money and go do whatever you want with it. But subscribe to the channel, turn on post notifications, all that good stuff. Check out my Udemy courses if you want to using the link in the description or the pinned comment. Really good value, learn stocks to the T. And I will see you at the next video.